Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Thursday. Hopefully everybody's having a GGD, a great green day in the market. You know I always wish the best for my viewers and subscribers. So today we're going to go over the overall portfolio value, of course the value by the metrics, my buying power, our individual holdings and how they're performing, see if there are any deals within the portfolio, see if there are any stocks that are overvalued that I wouldn't buy at this current time. And then of course we're going to take a look at the watch list, the 2 stocks that I have on there and what prices I'd purchase them at. So for today, we are down about $200. It says 210, then I'm up 60, so I'm down about $200. Then for the 1 week mark, we are up $460, a 0.78% return. That 1 month mark, up $546 with about a 1% return. 3 month mark, we're up $3,400, 6.15% return. Year to date, we're up $9,700 with a 19.5% return. 1 year mark, we're up $13,000 with a 28% return. And then all time, we're up $24,231, a 68.59 or 0.6% return all time. Buying power sitting at 110.19. We did just get paid by Realty Income. That is a monthly dividend paying stock. So every single month we get added about $45 guaranteed from Realty Income. So that did boost our dividend income. With those purchases of Apple, when it comes to the Altria dividend, it got reinvested into Apple. And so the Realty Income dividend is just going to sit and wait until November when I get that AbbVie and Apple dividend, and as well as the next Realty Income dividend should cover a share of Visa. So I'm excited about that. That dividend snowball is growing, and month over month my income has been increasing, which is awesome to see. So jumping into the individual holdings, starting off with the Dividend Aristocrat, Realty Income, ticker symbol O, at $64.23 today, 171 shares, nearly $11,000 of market value. Average cost is about $65 per share. 18.5% of the portfolio is in Realty Income. Today we're break even. Total we're down $134 with a 1.21% loss. A small opportunity here to cost down average and a great quality real estate company. The thing is, guys, I'm more focused on Apple and Visa at this current moment, but with that 110 I could buy nearly 2 shares of Realty Income. Eventually the goal is to have Realty Income buy a share of itself every single month, because that will really start compounding. It will take a lot of capital, but that is the long-term goal with this position. As of right now, though, it's kind of on the back burner. I'm more focused on Apple and Visa as of right now, but still a good opportunity here. Then Altria is just below $50 at $49.77, 320 shares, $15,900 of market value. Average cost is right around $47.30, so we're still in the green here. Around 27% of the portfolio is in Altria. Today we are down $124. Total we're up nearly $800 with a 5.3% return. Guys, I love Altria. It is by far the single biggest payer when it comes to dividends, and it is buying me now, as long as Apple stays below like $280 a share, it should buy me at least a single share. With that Realty Income dividend, it'll buy me 2 shares of Apple for the rest of my life. So it's really going to help me build that quality position in Apple, and that will definitely snowball and help it grow a lot quicker. So I'm happy that I have a lot of cash in it, but it is not one of those companies that I'm looking to purchase at the current time. It is a little bit overvalued above my average cost, and it's doing its job, right? So I could put more cash into Altria and buy, it was about 300, say it's like $300. So I could buy nearly 6 shares of it every time it pays. So I do have enough to fulfill my goal with Realty Income to buy a share of itself. But right now I'm focused on buying more Apple. Then we got Coca-Cola dropping a little bit here at $69.90. Still about $70 a share. 15 shares of this Dividend King. Right around $1,050 of market value. Average cost is $60.54. 1.7% of the portfolio is in Coca-Cola. Today we're down $10. Total we're up $140 with a around a 15.5% return. Guys, this is too big of a premium for me to be paying for Coca-Cola. It's a slow grower. I do understand that. I want it for the brand. I drink a Coca-Cola product at least once a day, probably more than that. And it's just one of my favorite brands. I love the taste of Coca-Cola. I love Sprite. So it's just one of those that I want to own it because I use it every day. and it is a quality dividend company. The dividend growth is slowing, but that is okay. For me, it's more about just owning a brand that I love. And honestly, guys, Apple and Visa are going to be the two big dividend compounders, I feel like, in the coming years, as well as Google could possibly be as well. So even though the dividend growth isn't, double digits in every single position I have, sometimes it's okay to take a little bit less on the dividend growth side if it's a quality company and if you just want to own it. Next up, we got Apple at $231.82. 8 shares now, almost. I got so used to saying 6. 8 shares now, $1,800 of market value. Average cost is $215.50. 3.12% of the portfolio is an Apple. I would be happy if that decimal point moved over when it was 31%. It will be someday if I want it to be that big of a position. Today we're up 32 cents. Total we're up $130 with about an 8% return, 7.5% return here on Apple. I'd still buy it as long as it's below like $250. I'm still purchasing Apple. Then we've got AbbVie sitting at $188.75, down almost $2 today. Whew. 95 shares, right around $17,900. I'm so used to that being $18K. Average cost is $95.19. 30% of the portfolio is an AbbVie. Today we're down 162, a 9.9% or 1% loss. We're up $8,888 with a 98% return. So guys, I've still nearly doubled my money that I've invested in this company, plus dividends, of course. If you add those in, I've definitely doubled my money. AbbVie's paying a dividend on the 15th of $147.25. I'm not sure if they will be announcing a dividend increase, but it has already gone from $1.07 to $1.55. So the dividend growth has been exponential with this company, as well as the capital appreciation. So I'm very happy with AbbVie, and I'm just going to use it to buy, T. Rowe Price for now, maybe a share of Google. Honestly, out of the three, I'd rather own more Visa, but Google will be a very big top 5 position as well. So AbbVie does fulfill its goal there of either buying a share of T. Rowe, and right now it could nearly buy a share of Google. It pays me $150, right around $150. So with that realty income dividend, it would secure either T. Rowe or Google as of right now. So not quite Visa yet. Visa's at almost $280, so it's not going to be, it's over $200 a share. So it's going to be quite a while, and considering that I haven't been able to purchase any AbbVie for a while, it will take a considerable amount of time for it to get to a $200 dividend. But that's what Apple's for. That's what realty income's for, is to kind of help balance out that monthly income. So overall, guys, just super happy with AbbVie. Then Visa's at $290, so up $2.83. 1 share. Average cost is right around $270. 0.5% of the portfolio is in Visa. Today we're up $3. Total we're up $22 with an 8% return here. So guys, I'd still buy it. I'm just gonna Visa is one of those that I'm just gonna add to as much as I can. Same with Apple. I do have prices that I would probably cut off and not purchase more, but Visa hasn't quite hit there yet. So I'm gonna just pour as much cash into Visa as I can once my debt's paid off. This will definitely be the first or second position. I do see the potential of Visa overtaking Apple as the single biggest position, just due to how well they compound money within the business and how well it's grown year over year. Then we got T. Rowe Price, which was up and then down today. I don't know what made that spike happen at 7 o'clock. I didn't see any news on it, but it's up to 113.03. 101 shares, a little over $11,400 of market value. Average cost is right around $110 per share. 19% of the portfolio is in T. Rowe Price. Today we're up 1.3%, $146 in the green. Total we're up $340 with a 3% return here on T. Rowe Price. Guys, I'm excited to see, a little bit of green here in T. Rowe. It's been kind of flat for the past couple of years. I'm okay with that. There's been a lot going on with like COVID, the economic shutdowns, people switching over into bonds. There's been a lot of, negativity towards just overall financial stocks. But I feel like T. Rowe does a really good job of compounding their money within the business. They're good at reinvesting back into the business, as well as rewarding shareholders and balancing out that give and take when it comes to growing the business and giving more capital to shareholders. So it's a very, very healthy payout ratio, very good business, and it's not very capital intensive. Once they have their funds, they can add more, but they're more, their business is more charging fees for their investment advice, essentially, or their funds. So their main business is assets under management and the fees that they get for people being in their funds. So it's one of those that, I mean, as long as people need to retire, I feel like it's pretty safe. It's kind of like, I think of it as like a Vanguard or a Charles Schwab. So I'm not worried about it overall. And honestly, if there's a big economic downturn again, I'm just going to buy more. And guys, if you've followed me for any amount of time, you know that, a couple years ago, I have been in and out of T Rowe, but I'm holding it for the long term. I was dumb and sold out of it. But it was at 222 at the high in 2021. So, I mean, there's no reason to think that it can't get that high again. And even if it doesn't, I'm still happy with the dividend growth that it's had. So overall, guys, I'm very bullish on T Rowe, and I plan on holding it for the long term. And then, of course, guys, we have the king of ads, Google. Guys, I'm more buying this for YouTube and that YouTube revenue. And it's been growing really fast year over year. I post videos on it. Try to do it almost every day. So, it'd be dumb not to own Google. I did own 3 shares and I sold it because I'm stupid. So I shouldn't have sold it. I can show you guys down here. But yeah, market sell. So I sold 3 shares, bought it, and sold it again. So I've been back and forth. Part of that is because I want to see what the DOJ is going to do. So I bought 3 shares and I was like, and then a report came out and I didn't like the report, so I sold it. So I love Google, right? I am I'm very bullish on Google in the long term. It's just, I don't know what they're going to do to change the business, if anything, right? Like, if they spin out YouTube, that's huge. If they spin out, like, the cloud, that's a really big deal. If they try to break up, like, a smaller piece, it won't affect me. It won't affect my, investment thesis very much. So, it's just, I want to own it, but I want to own it knowing what they're going to do to it, right? So, it's kind of like when you buy a car, right? Like, you want to know who owned it and what happened to it. You're not just going to, you're going to wait for it to be assessed. And then after that assessment, you buy the car. So that's kind of where I'm like, I love the business. I understand the business. The revenue growth within it is amazing. And I love the way it's run. I love the capital allocation within Google and the management. Everything aligns with the business. It's just, I want to know what they're going to do and how that change is going to impact the business going forward. So once all of that, DOJ stuff and the lawsuits are done, I will be putting money into Google, a lot. It's going to be one of my top 5 positions. I've just been a little bit back and forth because I don't know how the lawsuits are going to affect Google long term. And then, guys, of course, we got Berkshire. This is one of those no-brainers for me. I love the Berkshire Annual Hathaway meeting. I love the float. And this is the best insurance company in the world, in my opinion. They just have insulation that other insurance companies don't have. I've looked at Aflac, T. Rowe Price, The Hartford. I've looked at Allstate. I've looked at Chubb. I love insurance. I love the business. The only issue that I have is there's a lot of risk when it comes to underwriting. So if you underwrite poorly, if people have more claims than what they pay for, then you're underwater. And with insurance companies, as long as they invest the float at a higher rate than what they pay out, they come out on top. So even if their underwriting is bad, they can still come out on top when it comes to their investment, because their investments kind of offset the money that they lost due to claims. So that's why I love insurance, is because most, not all, but most of the time, if you assess risk properly when it comes to insurance, you will make money. But a lot of times when something like a hurricane, like what just happened in Florida, or 9/11 happens, right? There's been so many big events that some of these insurance companies have not foreseen, that I'm not 100% comfortable with owning just an insurance company. And so that's what sets Berkshire apart for me, is that yes, they have a massive insurance business, but they also have companies like Dairy Queen, See's Candy, Acme Brick, Benjamin Moore Paints. They have so many different businesses, as well as the companies that they own on the publicly traded stock exchange, that I feel like if they do have a bad year of underwriting, they have so many other revenue streams coming into that business that they're not screwed when it comes to just insurance. So that's why I like Berkshire, is because they have the insurance aspect that I love, and they're very good at capital allocation within the business, but they're not like just, they don't have a history of bad underwriting, right? They're not totally screwed if a hurricane hits in a place that they have cars insured, right? Something like that. They have a lot of cash on the sidelines, just in case there's a big claim that they know they're going to have to cover. So I believe Buffett said he needed like $20 billion to run the business to keep everything afloat and not have any issues. I would probably say they've bought a lot of business. I don't know how many businesses they bought since then, but let's say they need 100. They have like 200 plus billion right now in cash. So in cash equivalents. So it's like, if there's something huge that'll like wipe out somebody like Chubb or Travelers, Buffett has enough money and Berkshire has enough money on the sidelines to cover whatever that is. So that gives me the peace of mind. Like, I know some people are freaking out because he has a lot of money on the sidelines. There's a reason for it, right? So that to me just shows like, hey, if shit hits the fan, if everything, like, if COVID happens, whatever, right? If we have something happens that's massive, we're ready. And that gives me the peace of mind to like put more money into Berkshire and make it one of my top 5 holdings, because even when Buffett's gone, I have a lot of faith in the people that he's picked to run the businesses. I mean, the businesses that he buys already have managers in them that have been running them for decades. People that he chooses to be managers have a passion for their business. And he lets them pour their lives into the business like they have been. They don't change once they're in Berkshire. And that's one of the things that I love, is he lets the business owners run their business. And he's trusted Greg Abel and Ajit Jain to run everything that's not insurance and insurance. And they've already been doing that, as Buffett has been teaching them and like mentoring them. So overall, I don't think there's anybody that could have run the businesses as well as the two that he picked, because they're already deeply ingrained in Berkshire. They understand the culture. They understand the businesses. And I think overall, Berkshire will do very well in the future. Plus, they have Ted and Todd Combs that are very good investors that have made a lot of money for Berkshire as well. So I just feel like they have the proper pieces in place to take over when Buffett goes, to keep Berkshire and its investors growing and happy. So definitely Berkshire is going to be one of my top 5. And I would buy it. I honestly, at this point, I might as well just buy it at $500 because I own myself 7 shares. My goal with Berkshire is to own a share per year that I've invested. So this is year 7, I believe. So it's like I own myself 7 shares right now. So I'm a little bit behind on that. I need about a 30K position, or I think it's let me see, $3,000. Sorry, yeah, I own myself about $3,500 of Berkshire by the end of this or next year. So I'm a little bit behind on my Berkshire investing, but I'm excited to own the stock, and I'll get to it once my debt's paid off. So with that all being said, guys, thank you so much for watching. Remember to hit the like button on this video. Hit subscribe on my channel, That Dividend Guy, if you guys enjoy the content and the portfolio updates. Thank you so much for watching, and I'll see you tomorrow with another Robinhood portfolio update. Take care, guys.